Hi everybody, this is Thomas Wynn, owner of Wynn Capital Management and Portfolio Manager. Today we're going to review the fourth quarter, and remember that during this presentation you can pause this if I'm going too fast or if you want to see the details of any particular slide. We're going to dive right in and review the performance of our Wynn Capital clients for the fourth quarter. Here you can see that all of our clients are in one of 6 models, from aggressive to ultra-conservative. This is their performance. This is the benchmark that we measure our performance against. These are invested in a similar way. They're diversified portfolios. This is the difference between our performance and the benchmark performance, and we beat in 5 out of 6 cases. This is the target stock allocation and bond allocation for each of these portfolios. And for the year, this is Wynn Capital Management, our client's performance, and the benchmark and the difference. And we're going to look at this a couple of different ways. I want to go over the disclosures. Our conservative, ultra-conservative, is measured against the Morningstar World Bond Index. Dow Jones doesn't have an appropriate bond index. All performance for the quarter and for the year is after all fees, after our management fee, expense ratios, and commissions, and anything else. Individual clients might have a different performance than what's shown in the model. The model is an average of all the clients in the model, and clients might make withdrawals or deposits or do other things that change the performance slightly. Past performance doesn't guarantee future performance, and for complete historical performance, you're welcome to call me anytime. Sorry, I skipped one. I wanted to just quickly review that. I'm going to even go back further. Clients that have been with us for a long time know that during up markets, and there have been up markets every year since '09 to the present, that we typically trail. Our outperformance is usually significant in down markets, and we lag slightly in up markets. So for 5 years in a row, the market's gone up. We're always attempting to outperform, but it's difficult because we manage risk. When you manage risk, you spend money on risk, and clients accept the benefit of downside protection, and we also accept slightly lagging on the upside. Now that's just a fact of life for almost all people that manage risk, all the managers that do. This time we overcame that, and despite being hedged for a good part of the fourth quarter and for the full year, we beat our benchmarks even though we were hedged. So that's kind of a double win. Good performance, outperformance with reduced risk is a difficult trick. And I just want to review that back in 2008, the last big bear market, I measured our performance for the year. The S&P was down 38% that year. It was down 60% for the full bear market from the end of 2000 to the beginning 2007 to the beginning of 2009, which was the whole duration of that bear market. But for the year itself of '08, we were down 25%, our average client, and then all of these 6 managers at one time or another have been named Manager of the Year, and each of those guys suffered pretty badly during 2008, as most managers did. And we outperformed each of those managers by the amount shown up above here. So these are great managers, and they manage risk to some degree, but not to the degree that we were able to during that year. And how we do it, I'm not going to go into great detail until later. I'll do different, we're going to make a big effort this year to continue to educate our clients and interested parties on how we do what we do. This is just a picture of something called a protective put. We use puts, we use calls, we use call verticals, we use iron condors, we use lots of fairly complex option strategies to try and manage our risk. Currently, we're using this one. And long story short is that most portfolios look like the dotted line. Right now, our portfolios look like the bold line, and our portfolios basically have a floor about 6% below the current price. And what that means is that $1 million account right now only has about 6% of their money at risk, no matter what news comes out and how far the market falls in the next 5 weeks. Most of our clients only have 6% of their capital at risk. Now, if you only have 6% of your capital at risk for $1 million, that's $60,000. And if you make 6%, your return is, on a risk-adjusted basis, is basically you doubled your money. The time-weighted return only shows 6%, but you had a tiny fraction of risk and you made a decent amount of money, and that's what we're trying to do. Now the cost of this and all the details we'll deal with in another video. And before I go, I am going to show one thing, which is pretty much the same thing. This is the same kind of chart. This is Thinkorswim Software, and I'm just going to illustrate the same thing on how we manage risk in a little different way. I've put into the software an account that's worth $500,000, and I've invested it fully, and it shows how much money you would make on that kind of an account and how much money you would lose on that kind of account without protection. And then if I push this little button down here, it shows the account with protection. Just like the protective put chart before, there's a floor under that account. And if you look at it in dollars, this column right here calculates the dollars on a 20% rise, 10 and 5 also, and similar losses. And on 20% gain, a $500,000 account will gain about $100,000 because 10% of 500,000 is 50. So there's a 50% gain on 10, and then double that is 100. And similarly, you'll lose equal amounts if you're not hedged. But with the hedge, you lose less on a 5%, you lose considerably less on a 10% decline, and you lose $60,000, almost $70,000 less on a very large decline of 20%. So why we do this, how we do this is going to be saved for another day, but I did want to dive into that just briefly. Go back to our slideshow, and then this is displaying our performance, the same as the Excel spreadsheet, for the fourth quarter with our performance win capital, our benchmarks, and this is the difference. And for 5 out of 6 portfolios, we were ahead. Only our ultra-conservative underperformed for that period. For the full year, this is the slide, and all of our portfolios outperformed. There's lots of reasons for that. New and better software, better research, more time dedicated to driving performance, the switch to DFA portfolios, all of those things combined to help us achieve our goal of good performance in both rising and falling markets. Now let's dive into the quarter. U.S. stocks were up big in the quarter. Developed stocks up, international stocks were up pretty nicely, but trailed U.S. Emerging markets gain, but trailed everything. Global real estate down slightly, U.S. bonds down slightly, and global bonds up a little bit. Most people might want to pause this and look at each of the details. This is the news of the quarter overlaid on the path that the market took. There was a little dip at the beginning, but it was a strong quarter, and the Fed taper happened at the end of the quarter, and I was anticipating that. This is why I was hedging. The hedge was meant to save us money, reduce our risk if there was a bad reaction to the taper. Instead, there was the market just took off after the Fed taper, and we ended the year really strongly. Strong quarter, strong year. In all over the world, all these different asset classes from the U.S. to all the different countries and subcategories. The U.S. was the leader this time. Different categories, almost all categories were up. A few things were down in the quarter. In U.S. stocks, all the categories were up, led by large cap. Small cap was the worst performing on a relative basis. And then this section over the next few slides shows the year-to-date and the 1 year, which is the same at the end of the year, the 3-year annualized return, 5-year annualized returns, and 10-year annualized returns. And U.S. stocks have had a fantastic run this year, and we're finally getting 5 years ago at the bottom of the bear market, returns were negative. Now we've had 5 good years, and it's bringing returns back up to positive. International stocks, same thing. Value was the leader, growth was the laggard, but great returns. And I didn't mention it before in the previous slide, but U.S. is 50% of global market cap. Developed foreign countries is 40% of global market cap. And again, here's the year-to-date 3, 5, and 10-year returns for that category. Emerging markets stand out as, even though they had a decent return with growth leading and value lagging in the quarter, positive returns, but the 1 year, the 3 year are negative. So we own a fair amount of emerging market stocks, and that's one reason why we did better than our benchmarks, but we didn't match the S&P 500 because the S&P 500 only has U.S. large cap, and our portfolios and our benchmarks were dragged down by performance here. But our outperformance was due to us underweighting this category and overrating U.S. large caps. Now, we don't know if that'll happen again this year, and we're trying to decide whether to go back to a neutral weighting or even an overweighting. But we got out of these because they had so many good years in a row that tons of investors got into them thinking that it would repeat forever, and they got overvalued, and we reduced our allocation. This shows quickly country returns for developed markets and emerging markets. Almost all developed were up, about 50-50 on emerging markets. Real estate down slightly globally, and returns over short and long periods. Commodities, volatile as always, with a few commodities up and a lot of commodities down. For the year, commodities were down 9.5. It's hard to believe that over the last 3 years, the average annual return in commodities was -8% because it seems so recent that commodities were doing fantastic due to China consuming all kinds of different commodities at a fantastic pace. But that is how it is at the moment. Fixed income, the 10-year U.S. Treasury bond is now 3% in January of last year. A year ago, the 10-year was 1.5%, so interest rates doubled during the last 12 months. Therefore, the price of bonds declined, and the year-to-date performance was very poor for most bond categories. And the worst was long bonds. We got out of long bonds about 2 years ago and have been in very short duration bonds, and that helped us, again, one of the things that provided the margin for us outperforming our benchmarks. Our benchmarks probably had intermediate average bonds, and we had short duration bonds, and we avoided this big decline in long-term bonds. This shows the path of different types of investing. If you're aggressive and 100% stocks, you had fantastic return this year, and in intermediate term and longer term, it shows the average annualized rate of return. And this graphic shows that if you have a conservative portfolio, you will get paid and you'll have a very smooth ride, but your total return is often lagging the other returns. And these people at the other end of the spectrum, during the middle of a bull market where we are right now, will have fantastic returns, but they will have suffered during, they have suffered great volatility. Most of our clients are in the middle. They can't accept the volatility and they can't accept the low returns, and we try to reduce the volatility with a moderate allocation. This is DFA's little ending blurb about how the news is at the beginning of the year. If you go back and look what everybody was writing, no one thought 2013 would be what it was. Very, very pessimistic. Country just gone through the, got downgraded, and we had the government shut down and all kinds of problems that lingered, and yet we had a fantastic year in the market. And that is it for the summary. I hope you find the material helpful, and if you have any questions, please don't hesitate to give me a call anytime. Thanks a lot. Bye-bye.